Hello, my name is Kyle McLean, and I'm a partner and senior wealth manager here with Rhame Gorrell Wealth Management. Today, we're going to be covering an incredibly lucrative tax strategy, the Mega Backdoor Roth conversion strategy. This strategy gives employees a way to supercharge tax-advantaged 401k savings beyond normal IRS limits. If you or someone you know could benefit from this strategy or any of the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to identify opportunities for optimization in investments, tax planning, estate planning, employer benefits, and retirement strategies. Let's jump into today's topic, the Mega Backdoor Roth conversion strategy. So, what is the Mega Backdoor Roth? At its core, this strategy is a tax strategy embedded within your 401k plan. By undertaking a series of transactions, employees can make 401k Roth contributions beyond normal IRS limits. For instance, in 2026, employees can contribute $24,500 either as a pre-tax or as Roth contributions, with a catch-up contribution of $8,000 for those age 50 or older. The Mega Backdoor Roth allows certain employees to add tens of thousands of additional dollars beyond that limit annually to their Roth account within the 401k. To fully understand this strategy, let's review how pre-tax versus Roth contributions work for tax purposes. As noted earlier, for 2026, employees can contribute $24,500 to the pre-tax account, the Roth account, or some combination of the two. Pre-tax contributions are made before taxes are paid, which reduces taxable income. However, both your original contributions as well as the growth on these contributions will be taxed upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid, meaning both the original contributions and all future growth are tax-free upon distribution. Deciding whether to make pre-tax or Roth contributions depends entirely upon an individual's current tax rate versus their anticipated future tax rate. This is a highly individualized calculation, which is why we suggest consulting with a tax specialist, such as our team, before making a final decision. Some 401k plans provide a third account, known as the after-tax account. This account is what allows us to facilitate the Mega Backdoor Roth conversion strategy. Let's discuss the tax features of the after-tax account, as it combines the least favorable elements of both the pre-tax and the Roth accounts. After-tax contributions, as the name implies, are made after federal income taxes have been paid. However, any growth within the after-tax account will be taxed as ordinary income upon distribution. To illustrate how this works, let's assume an employee earns $250,000 and their company provides a 7% match, which comes out to $17,500 per year. In this scenario, the total amount going into the 401k for an individual maximizing pre-tax contributions would be $42,000, $24,500 from the employee's payroll deductions, and $17,500 from the employer's match. This $42,000 total is well below the total contributions the IRS allows from all sources into a 401k for the year, which is $72,000 for those under age 50 and $80,000 for those age 50 and older. So, where can this $30,000 difference between the IRS limit and the other maximum contributions go? As you might have guessed, it goes into the after-tax account. At this point, you may be wondering, why would anyone contribute to an account with no immediate tax reduction benefit, but all growth will eventually be taxed as ordinary income at the highest marginal tax rate? The answer is that we don't leave the funds in the after-tax account to grow indefinitely. Using this strategy, all of the after-tax funds will be converted to Roth. And the best part? If the funds are converted to Roth before they have time to grow, the conversion is entirely tax-free. Here's how it works. Once pre-tax or Roth contributions reach the IRS limit for the year, employees can start making contributions to the after-tax account. Some 401k plans allow this automatically, while others require employees to elect this treatment for additional contributions. Once the funds are in the after-tax account, they are converted into the Roth account, where they can grow tax-free until they're distributed in retirement. Every plan is different. Some 401k plans allow multiple conversions per year, while others limit the number of conversions that can be made annually. At this point, it should be clear that this strategy can be a tax game changer for retirement savers. Some of you may be wondering, instead of the Mega Roth strategy, where else could these dollars be saved? The primary alternative would be to save into a taxable brokerage account. However, brokerage account earnings are typically subject to a 15 to 20% long-term capital gains tax, or an ordinary income tax rate of up to 37% on interest income or short-term capital gains. To better illustrate the tax benefits of this strategy, we'll compare an individual who fully utilizes the Mega Backdoor Roth strategy over their career versus diverting the same after-tax funds into a taxable brokerage account. Using the same numbers from the example, let's say this employee contributes $30,000 per year for 20 years to a brokerage account. Assuming an 8% growth rate, these contributions will grow to $1.37 million over the 20-year period. This means that within the taxable brokerage account, there will have been $600,000 of contributions and roughly $772,000 of growth. Assuming a 15% long-term capital gains rate, this will result in over $115,000 of taxes paid when the assets are sold. If instead, this employee utilized the Mega Roth strategy over the same 20-year time frame, all of the dollars could be distributed in a tax-free manner, resulting in well over $100,000 of tax savings. Before we wrap up, I want to highlight an important consideration when using this strategy. If you have a pre-existing after-tax balance within your 401k, or if growth has occurred on recent contributions, you need to be aware of the Pro-Rata Rule. This rule states that if an after-tax account contains a mixture of contributions and growth, any conversion or distribution from the account will be partially taxable based on the ratio of contributions to earnings. For example, if over 5 years, one contributed $150,000 to the after-tax account and it grows to $200,000, then 25% of every dollar withdrawn or converted would be taxable. The best way to avoid the pro-rata rule is to make sure regular conversions of after-tax dollars before growth occurs. If you have a pre-existing after-tax account balance that contains growth, some 401k plans offer options to help employees clean the slate and open up access to the Mega Backdoor Roth conversion strategy. Because 401k rules vary for every plan, we highly recommend discussing the impact of your current after-tax account balance with a tax expert, such as our team, who can help you understand the tax implications of future conversions. Thank you for spending time with us today to learn about the Mega Backdoor Roth strategy. At Rhame Gorrell Wealth Management, we have over $1 billion in assets under management. And as a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.